Morning everyone, thank you for joining us today for today's Energy Bill Relief Scheme webinar. We're just going to give it one more minute to give everybody a chance to join us. Hello to those people that are just joining us. We're just giving it another 30 seconds or so because I can see we've still got some more people joining. Right, let's make a start. Morning everyone, my name's Helen Gardner. I am Market Policy Change Leader at Empower Business Solutions. We've put on this special webinar today to go into the Energy Bill Relief Scheme. Hopefully we'll be able to make it a lot clearer for you today, and we've also had lots and lots of pre-submitted questions, so we're going to try and get through as much content as we can. I'm joined by experts from across Empower Business Solutions and E.ON colleagues that are hopefully going to give you all the information that you need to know. We've got loads to get through, so just to take a look at the agenda. As I said, we've got over 200 questions that have been submitted. What we've done is we've taken some of the key themes that have come out of those questions and shaped a bit of an agenda around that. Rob Finch, manager of our regulation team, and Matt Cullen from our policy team are going to start by talking about what the government have announced and why so far. And then Matt Gallagher, our Market Policy Change Team Manager, and Stephen Evans, the manager of our Industry Charging Team, are going to go through how the scheme will work in practice and also walk through some examples for us. We'll then spend the rest of the time going through those questions. So if you do have any questions as we go along, I can see we've already had some come through, so please use the ask a question function that you'll be able to see on your screen now. If we don't get to your question during the webinar, then we will email you afterwards to provide you with a response. So we'll try and get through as many as we can. If we go to the next slide. So just before we start, we have to say that everything that we're going to cover today is based on the information we've had from BEIS as of this morning. So that's the 20th of October. It's still subject to change. We've got BEIS are still working with the industry on how the scheme will work in practice, and the energy prices bill has not yet been passed into law. So it is subject to change. To get the latest information after today, we'd recommend to look on the BEIS website directly, and we'll also be keeping our FAQs on our website up to date. So you can find those at www.empowerbusinesssolutions.com/EBRS #FAQ. So all the information you need after today, if you go to either of those websites, that will be the latest information. Everything we're talking today is about in general terms. So what we're not going to be doing for obvious reasons is going into specific customer arrangements and any bespoke arrangements. So if you do have any specific questions, then please speak to your client lead afterwards to be able to provide you with specific information on your circumstances. So with no further ado, let's make a start, and I'll hand you over to Rob and Matt.
Well, welcome everyone. My name's Matt Cullen, and as Helen said, I work in our policy team here at E.ON and Empower Business Solutions. I focus primarily on wholesale pricing and network charging. If you move on to the next slide, please, Tom, I can just sort of set the scene of why the government is bringing in this energy bill, which is probably the most stupid question in this pack, because I think it's fairly well understood by pretty much everybody on this call that energy prices have just gone through the roof during this year. And you can see there the charts that just clearly indicate the scale of the issue. Normally, we talk about prices being down at the sort of level of 100 to 200 pence a therm, or 150 pounds a megawatt hour for certain products. But you can see that those have risen fivefold easily over the last 12 months. They have come off a bit recently, and obviously there's been some news of gas prices softening even more lately, but I think it's fair to say that we are definitely not out of this crisis, that the government is still working hard behind the scenes along with industry to try and remedy this. And the reasons behind it, I guess, are fairly well understood, but just to sort of reiterate, we did see a huge global return of demand after the COVID crisis of 2020, 2021, which was driving up prices already. And then, of course, the invasion of Ukraine by Russia and the subsequent Putin using exported gas to weaponizing exported gas against the EU has then obviously sent the markets into turmoil. We're clearly struggling as a continent to ensure that we have enough gas stored away for the winter. But yes, it became very clear to government, probably not early enough, unfortunately, but that support would be needed for domestic customers for initially, and then business customers latterly. But I will leave that part of the conversation to my colleague Rob Finch, who will then take you through that support that the government are starting to offer.
Thanks, Matt. I'll be on to the next slide. Yeah, and good morning, everyone. Great to be with you today. So Matt's positioned some of the background in terms of the volatility of the market. On the questions that we've had submitted prior to the webinar, it's very evident that there's some confusion about what schemes are in place and how they're going to operate. So I'd just like to take a few minutes just to do a bit of a recap and dust down of what's actually out there for homes and businesses. So the government in September of 22 announced that they would undertake a major support package to help consumers, whether domestic or business, and that would fall across three key activities or themes. One is the energy price guarantee, which is targeted for households or domestic customers in regulatory terms, and that's essentially looking to restrict the level of increase that customers could be open to where there's that market volatility. And you'll hear mentioned quite often this typical £2,500 a year cap. I think the key thing to state is it's not a cap, it's a discount. The more you use, the more you'll pay, and the less you use, the less you'll pay. But essentially the government is taking the hit on the balance sheet for that wholesale increase that we're foreseeing over the winter of 22-23. So the difference that suppliers are having to pay will be underwritten by government. The second scheme was the Energy Bill Support Scheme, again, domestically driven, and that was announced just before the summer. That's looking to make payment of £400 between October 22 to March 23 in 6 equal instalments. Those credits either being applied to customers' bank accounts, their bill statements, or in some cases where they've got prepayment meters, whether traditional or smart, put onto the meter. So essentially, they receive it at the point of use. And the final thing that was announced was the Energy Bill Relief Scheme, the EBRS, which was focused on the business sector, and it will be where you guys on the call today are really interested. I think the other thing to just note is there are other social support schemes in place in terms of the £150 council tax relief, and clearly additional support for vulnerable and those socially people who need help. I've put on the bottom of this slide, clearly we had the announcement from the Chancellor of the Exchequer on Monday, Jeremy Hunt, about rowing back some of these schemes. So the EPG was originally initiated as a 2-year scheme. That's now destined to run until April the 1st of next year, so 6 months only. And I'll come back onto that later in the slides. But clearly the Treasury announcement, picking up Helen's point in terms of we're sharing what we know today, and there are still some features that are unknown and have not been locked down. Can we go to the next slide, please? So coming back directly to the EBRS scheme, what is it and what's the headlines? It's basically a scheme that's looking to operate as a discount. So similarly to the EPG, it's not a cap, and the same principles apply. If you use more, you pay more, and if you use less, you pay less. But it's looking to take the peak out of the wholesale costs by giving all qualifying customers a discount, which is then again underwritten by the government in terms of the public purse. It will include the removal of green levies, but those levies will continue to be shown on the bill and they'll be absorbed by the government, and we're waiting for some more information on that to come. The scheme will apply to all fixed term contracts agreed on or after the 1st of December 2021. And it will also apply to all deemed default, variable and flexible products where they qualify. It will operate for a 6-month period for all energy consumed between October 22 and the 31st of March 2023. So the discount is based on not projected usage, but actual usage that goes through the meter. Originally, the scheme had a 3-month review in it, which was for the Secretary of State to make sure that it was operating as required. I guess with the Secretary of State's Chancellor's announcement on Monday, we're kind of trying to work out what happens next in terms of that review and whether or not it's just all consolidated into the whole energy package of what government wants to do beyond March of next year. But as the bill has been submitted to Parliament, and it went through its second reading, I think, yesterday in Parliament, it remains that there's a 3-month review. The Secretary of State does have the powers to intervene in the scheme at any time where it's felt materially necessary. Industry are challenging that in terms of just trying to put some rules around when and where and if there's any tinkering to be done. Clearly, what we're looking for is the ideal situation is a 6-month period where we've got a clean line of sight of what we need to do and how we need to do it. And any intervention obviously just brings into play complication. So we're trying to avoid that. Go to the next slide, please. So again, I think the first bullet point I've already captured. In terms of the future of any of these schemes, the mood music that we're getting from government is that perhaps any scheme that continues beyond March of next year will be more targeted and not so much broad brush, and targeting might be at a vulnerability level in terms of consumers' vulnerability to the pressures and influences of escalating prices in the market. But as it stands at the moment, frankly, it's just too early to say with any confidence what might happen beyond March of next year. So it's a big question mark. The scheme's designed to be automatic, so customers don't need to enroll. They don't need to do anything in terms of prompting their suppliers. Suppliers will action the scheme directly and send invoices through automatically to all of those customers and contracts that meet the eligibility criteria. It will be applied depending on the type of product, tariff and contract that you are on. So if you're on a fixed contract that was entered into on or after the 1st of December, you'll have a discount applied to your consumption based on a lookup table that BEIS will publish, which will give daily reference points for wholesale costs over the duration of the scheme. So that will guide suppliers in terms of what discounts given, and will also ensure that all suppliers are acting in common good. The government supported price that they've published is £211 per megawatt hour for electricity and £75 per megawatt hour for gas. And that equates to 21.1 pence a kilowatt for electricity and 7.5 pence per kilowatt for gas. Recognising that those customers are on deemed variable, flexible products, the government has actually put in place a supported wholesale price, which is set at a maximum level of £345 per megawatt hour for electricity and £91 per megawatt hour for gas. So that's the maximum that you can receive if you're on one of those products. And those two products in themselves create a floor price and a maximum price. And the reason for highlighting that to you is that if your purchasing strategy and commercial arrangements means that you're actually operating today below that minimum price that government's put forward, then essentially you would not receive any support. So if you're below the 21 pence threshold, you wouldn't qualify and wouldn't receive any discount. Likewise, you can't go above the maximums that have been set. There are exclusions to accessing the scheme. So that's businesses. I think we need the next slide, actually. Thank you. Yep. There are some exclusions, which are businesses, by way of example, that are generating or using electricity and gas for generating of power that they're selling back to the grid. That would be an exclusion. Although CHP units where the electricity and heat being generated is being used for the site is absolutely permissible. And then finally, a couple of points in terms of where are we at in the legislative process. As I've said, the scheme has been laid before Parliament. It is going through its readings, one being last night. And that's really to establish the bill and give the government the powers to establish the scheme and to make sure that all the benefits that the scheme is intended to deliver are passed on to consumers that need it, and also to ensure that there's an effective compliance and enforcement regime. So clearly, where suppliers are claiming back those costs from government, that process will be fully audited, will be fully transparent, and will fail and pass depending on the information that suppliers provide to government. So the auditing activity will be very stringent. And then finally, the Act makes it really, really clear that suppliers and consumers should operate the scheme for the purposes that it's been intended. So they're not looking for suppliers and or consumers to change their purchasing and usage behaviours to try and gain an advantage through the use of the scheme. That in effect would disqualify any participation. So again, just a couple of things to call out at this point. Hopefully that was helpful in terms of some background and some of the headlines of the scheme. I'll hand over now to Matt and Stephen, who will bring it to life in so far as some worked examples.
Yeah, just before you start, Matt and Stephen, I guess just to say we've had a few questions about accessing the slides. You will get the slides after the webinar, and there'll also be a link to where you can watch the webinar again. So it is being recorded, and you'll get that sent to your email address. Sorry, carry on, guys.
No problem. Thanks, Helen. Good morning, all. I'm Matt Gallagher, and I'm just going to talk through. We've got a couple of fairly simple illustrative examples to try and bring to life how you might see this appear on your invoices and how the discounts are worked out and would be applied. So the first example I'm talking about here is for a fixed price contract. This customer has signed a contract as of the 9th of September this year. It's a 6-month contract covering the winter period, so 1st of October 22 to March 23. What you're looking at there on the top line is just the customer's pricing. So this is a half-hourly meter. So we can see we've got some capacity charges in there, standing charges, and the day and night rate for the period in question. And then on the bottom, the second row, this is just showing the costs for those charges. And then partway across, we've added in the discount. So to work out that discount, what we've looked at is the colourful chart at the bottom. That's a direct extract from the published rates from the government website. And you can look across and see the rates for the 9th of September. We've got 38.74 pence. So that's the discount that this customer is entitled to. That discount is applied to all of their metered consumption. So at this point, when we're looking at the whole contract, to estimate the value of that discount, we look at the combined consumption across their 2 unit rates, the day and night rates. We multiply that up by the discount rate. And in this case, that gives a discount of £790,000. And that is reduced from their total cost, which is the 1.763 total on the priced contract. So the discount is independent of all the other costs, and it only applies to the metered consumption. So in this case, that's an estimate for the year. Then each month when we invoice the customer, they will see that discount rate applied to their usage. So it's the total metered consumption of the invoiced period for each month of October through to March. So that's a simple fixed price example. If we move on to the next example. So we've got one here for a flex customer. Now this is just one illustration. So for flex contracts, there will be slight variations in how their discounts are worked out, depending on the type of contract that you're on and the type of trades that you've made in the market. For this example, we've got a customer who is on a shape fee type contract. So for NBS, that's a streamline or a fast flex contract type. And this customer has been trading base load and peak load. So for those customers, the input to how we calculate their discount are the base load and peak load trades. The shape fee is not part of that calculation. So this customer has been purchasing volume starting in June 21. So the table in the middle, the top in the middle, is just a list of all the trades that they've done across the period. So we've got base load and peak load trades in there and the volumes. And what we're showing there then is the total cost of their trades and the total volume that they've traded. We can then use that to work out what the customer's weighted average trade price is. So that weighted average trade price is then used to compare to the government supported price. So in this case, in the small table on the right, we're seeing a weighted average trade price of £333 a megawatt hour. We compare that to the 211, which in this case gives £122.16, and that's the discount the customer is eligible for. So then when we come to invoicing the customer, we've got to apply that on their invoice. So the table at the bottom is just it's a mock-up of an invoice. You know, you may have much more detail, but this is just for illustration purposes. So you can see we would calculate the invoice as normal. So you'd have your commodity costs at the calculated weighted average price. On top of that, you get your distribution losses, transmission losses, any fees that have been agreed in the contract. There might be risk fees, management fees, and the shape fee in this case, and then all the third-party costs. So you see your normal invoice costs, and then separately, we apply the discount rate as a credit, and that's at the calculated rate of £122 a megawatt hour in this case. And that applies to all of the metered consumption for the invoice period. And what the customer ends up paying is the net value of the invoice. So I guess it's worth saying, you know, there are variations. These are just two relatively straightforward examples, but that gives some feel for how the discounts are calculated, how they will ultimately appear when you become invoiced. And this is invoices that will your October consumption. That's the first time you may see these. And I'll hand over to Stephen now, I think.
Yep. Hello, everyone, and thank you for joining us today. Thank you, Matt, for showing us the breakdowns. I think people will find that really helpful. I'm here to talk about industry cost effects of it. And in particular, you showed on the last slide how there is an overall discount that's applied to your total bill. And I wanted to start with the middle point in there about green levies being funded by the government. And this is quite a confusing one to understand or to try and explain, because we've got headlines about how the scheme previously funded by green levies will also continue to be funded by the government. Yet on the previous slide, we clearly saw the network and policy costs, which include green levies, being charged. And the solution to that is that the principle is that the EBRS discount that everyone will be offered will be greater than the cost of the industry, the green levies that they would be charged, and therefore the EBRS relief is covering the green levy, and any excess over and above the green levies is covering other parts of the bill, such as the wholesale. There's already been a question in the chat about which green levies will be covered. Unfortunately, the government haven't announced that yet. To be honest, I don't think they even will do. There are a number of different green levies it could include, such as RO and FIT and climate change levy, but they haven't stated yet which ones will, and they may not. But the point is simply that the size of the relief is likely to be greater than all of the policy costs, all of the green levies that will be charged to people. The second point to talk about then is around the taxation of RO and nuclear. This is coming out of the energy prices bill, and it doesn't directly affect people's bills, although you need to be aware of it because it could affect it in the future. And the idea here is that renewables on RO scheme and nuclear, they are actually very cheap to run on a variable cost. They can happily run for, say, £20 a megawatt hour. So we saw a couple of years ago during the really low prices during lockdown in 2020 that the RO generation nuclear, they were very happily generating because they were getting more than enough money income to support themselves. And they're having a great time at the moment because wholesale prices are up at more like £400 a megawatt hour. And after their costs, they're still making a profit in excess of £380 a megawatt hour. And the government don't think that this is fair for customers to be paying a lot when there's these windfall profits being made by RO and nuclear generators. So from the 1st of January next year, they're going to introduce what's known as the cost plus revenue limit. This is, I suppose, as the name suggests, the government putting a limit on the amount of revenue that RO and nuclear generators can make, and this revenue limit being set at just above the cost plus of generating, and this will gather a load of money. How will that money be spent? Well, the government could pocket it for themselves. It could be used to fund things like the energy price guarantee in the EBRS. It could even be, they could even introduce a new industry revenue or benefit for us for customers to pass it back. We don't know. The government hasn't confirmed anything yet. However, it does also signpost into the final way in which industry costs could be affected by all of this, which is they're opening up or creating a new process from next year for existing generators, i.e. existing RO and nuclear generators who are being taxed, to join the contracts for difference, at which point they would no longer be subject to this tax. And any generators moving into this would have their revenue capped at the strike price, which is agreed with the government. It would probably need to be a bit more generous than the cost plus revenue limit in order to incentivize people, but an RO generator moving across would reduce the amount of RO that we would all have to pay, and it would probably also increase the contracts for difference benefit that we're all getting at the moment as a result of that. So 3 ways in which industry costs are affected by this news, although the second and third not immediately. The message with that is that energy invoices could be benefiting from some of those changes in the longer term. I see, hopefully we're reasonably well for time, and I know we've got a lot of questions, so I'll hand back to Helen to handle those.
Thank you, everyone. That's definitely made it clearer for me. I think that the examples in particular are really useful because there's a lot of confusion around the numbers and whether it's capped or exactly how that will apply depending on the contract. So we might repeat ourselves, but I think it's useful just to get a very complex scheme clear for everybody when I start to go through some of the questions. I will direct the questions to one of our experts, but feel free everybody else to chip in as well as you wish. So the first question that we've had is, does the scheme apply to contracts agreed in October 2021? And Rob, if you could answer that one, please.
In simple terms, the answer would be no, but I think I need to just qualify that. So in terms of qualification, if you're on an existing fixed price contract, which was agreed on or after the 1st of December 2021, you would qualify. If you sign a new fixed price contract on or after the 1st of October 2022, you would qualify. And if you're on deemed, default, or any other variable product or flexible product, you would also qualify. So the guidance is quite clear, Helen, in terms of the lines that you have to be passed in order to qualify. And I think, as I said in my preamble, if you don't meet that requirement, and also in situations where you do qualify, where your purchasing is below the government scheme levels, even though you qualify, you wouldn't actually receive any discount on the energy that you're consuming. Does that answer that question?
Thanks, Rob. Yes, it does. So effectively, they're looking to support contracts affected by the energy prices crisis. If your contract was agreed before and covers this winter, then it wouldn't be deemed eligible. Thank you.
That's great. Thank you.
So the second question, do we need to be in a fixed contract to qualify? Matt G, can you answer?
Yes, sure. Thanks, Helen. So the simple answer is no. The scheme applies to all types of contracts, as we've mentioned, so fixed, variable, flex, and deemed and default products. Whether you qualify or not is, as Rob said, it will be dictated by the type of product you're on, the dates when you signed your contracts, and whether your hedging is above or below the supported prices.
We have had a few extra questions actually around deemed and default. So deemed and default contracts are also eligible for this price support.
They are, yes.
Thank you. The next question, so what happens if the customer comes out of a contract during the 6 months of support? Matt or Rob, one of you able to answer that?
Sure, yeah, I'll take that question. So, as is normally the case, if you drop out of a contract in a period, you'll fall onto our default rates. I think that's the same for all suppliers, unless you sign a renewal. And if that is within the period of the scheme, you'll become eligible for the discounts that are applied to those default rates. The customer wouldn't need to do anything. Again, that would be automatically applied by the supplier.
Okay. I think on a similar line.
Just to add for Matt, clearly that would be a decision that the customer would take in terms of whether they wanted to renew with a supplier for a fixed rate period or to drop onto those deemed rates. But that's a decision for the customer to take. Supplier wouldn't automatically carry on. We would put them on default, I guess, if in the event that they was out of contract.
Yeah.
Thank you. How does the EBRS get applied if you have fixed and variable tariffs for gas and electricity? Matt, you again, if that's okay.
Yes, sure. So I'm interpreting this question as we've got a single customer who has different contract arrangements for different parts of their supply. So each contract will be treated individually, and the supplier will apply the discounts as we've described, depending on the rules of the scheme. So, for a fixed contract, we would be looking at the discounts, the published discount rates, and applying those based on the contract sign date. What I would say is, so for NBS, we don't have variable tariffs or variable contracts, fixed contracts. So if you do think you're on a product like that, I would advise you to speak to your client lead, because that's not one of the products that we offer. And then just briefly, so if you had some of your supply on a flexible purchasing contract, again, we'd be looking at the purchases for each month, working out the weighted average price as we've described, and applying the discount appropriately. So each contract is managed individually, I think is the key message there.
Yeah, thank you. Next question then. So what guidance can be provided on the approximate pence per kilowatt hour arising from the implementation of the £211 a megawatt hour and £75 a megawatt hour commodity costs for electricity and gas respectively? Rob, could you answer that one, please?
Yeah, thanks, Helen. So essentially, as I described in my bit and Matt showed with his illustrations, the effective pence per kilowatt hour for the government supported price is 21.1 pence per kilowatt hour for electricity and 7.5 pence per kilowatt hour for gas. Clearly, if you're qualifying for the maximum scheme, then it would be 34.5 pence per kilowatt hour for electricity and 9.1 pence per kilowatt hour for gas. How that actually shows in the bills that you receive will be dependent on the reference price that we determine from the government's lookup, and then obviously how much energy you've consumed in a given period. So can't give any sort of financial ranges here, but clearly that's the formula that we would apply.
And Rob, we had another question related to that to say, are the wholesale prices already published by BEIS that will be used for that calculation?
Yes, I think they are, yes.
Yes, yeah. So the They've published the wholesale reference prices and the discount rates up until I think it's Sunday, just gone, and they'll be adding to those on a weekly basis in retrospect. So each week we'll see the previous week's discount rates and reference prices published.
And that's publicly available, Helen.
Fantastic, thank you. Stephen, one for you, please. So how will the EBRS impact customers on pass-through contracts?
Yeah, great question. And we've got some other related ones in the I've seen as well. The simple answer is that the and pass-through is talking about whether the industry costs are fixed in advance, or whether the industry costs that you pay are whatever the actual published rates are and are passed back. So there might be green levies that are on pass-through, and does that make any difference to the amount of discount that you're getting? The short answer is no. The size of the discount is solely based on your wholesale price that you'd achieved versus the supported price and the difference between them. So, for example, we had a question: if your contract energy price is below the support price, a green charge is discounted. And from what we've seen from the government, it suggests that the answer is no. Your green levies are only paid by the government, while your wholesale cost is in excess of the supported price. That's not great news, but from what the government has said, that seems to be the answer.
Okay, thank you. And while I've got you, so how will this work for customers that use flexible baskets?
Yep, so flexible baskets, similar approach to before. Flexible baskets will achieve a wholesale achieved weighted price, and then that will be compared against the supported price, and they will get a discount if their average weighted price is greater than the supported price.
Thank you. Will there be any impact on TCR charges? Matt, can you provide an answer?
Yeah, sure, that's fine. So the targeted charging review, or TCR charges, are network charges, and so they will be independent of this, and so completely unaffected, I'm afraid. So that yes, they will still apply.
Thank you. So next question: as the EBRS applies to the wholesale price, what as a percentage is the wholesale element to the total costs charged? That kind of flows quite nicely.
Yep.
Stephen, is that for you?
Yep, that's absolutely fine. And the answer, unfortunately, is it depends. So different contracts and different purchasing will give you different wholesale elements, whereas we have a fixed supported price that the government is willing to honour. A couple of years ago, the wholesale price element was probably less than 50%, possibly even less than 40% when wholesale prices were really low. It's probably, for most customers on this call, well in excess of 50%, possibly even 75%. But the percentages, I'm afraid, will vary from customer to customer.
Okay, thank you. We've actually had a few questions around this. So how will gas used by CHP be treated where some but not all of the electricity generated is exported to the grid? So Matt Cullen, could you answer that one?
Yeah, sure. This is obviously quite an important question if you have a CHP. The current thinking is that if your CHP is exporting to the grid, so exporting electricity to the grid, that proportion of the gas that you are buying will not qualify for these costs, for these discounts. But any electricity that is used on site, or any heat that is generated and used on site, the gas that you are buying to generate that electricity and that gas will qualify. So it sounds simple, but I think there's going to be a fairly tortuous methodology of trying to work out how much of the gas counts and how much of the gas doesn't. But general rule of thumb is, if you're exporting a lot onto the grid, then your discount won't be anywhere near as high as if you were using it all on site.
Thanks, Matt. And I guess that those are the types of arrangements that might be worth having an individual conversation about as well with your client lead. So we've had this one multiple times as well, and I think we've touched on it, but it's worth repeating. So which green levies will the government be paying on our behalf?
We have indeed. For example, Origo certificate prices affected, and what about non-commodity charges? To be very clear, there is a single discount applied to your total bill. So you will be charged all of your non-commodity costs, including your low carbon levies, such as RO and FIT, as well as your wholesale cost and your network costs. You'll be charged all of them, and then there'll be one total discount being offered to it, which is based purely on the difference between your wholesale achieved price and the supported price. And the principle and the idea that the government is trying to communicate is that that is likely for many customers, although, as we've talked about, not all, to cover green levies. So we don't know which green levies are covered, and for some customers it won't cover all of the green levies. For some customers, I'm afraid, it won't cover any of the green levies. Apologies for that. It's not a great message.
So it's not actually going to be touching the ROC scheme either, is it? And anything to do with generators for this purpose?
So the renewable obligation is a low carbon levy, and if your achieved wholesale price is very high compared to the support price, then the benefit you get is likely to be greater than your RO cost. So in that sense, it would be covering it, but there's no direct covering of this is a cost and this is the coverage of this cost. It's just a blanket benefit based on your wholesale cost.
Thank you. So Matt Gallagher, I'm going to come to you next, and I'm going to throw in a live question that's come through as well. So the question is, how and when will this show up on bills, i.e. as an itemised reduction? And also we had a question to say, can and will it be backdated?
So let me pick those off one at a time. So our intention, and we're working, on our technical solution and our billing systems to try and implement this in time so that we can bill the October consumption in November with the discounts applied. That's obviously subject to the legislation being passed first, which is a prerequisite. But assuming that goes through, our intention is, to be in a position where we can not have to backdate essentially and bill during November for your October consumption and apply the discounts there. Our approach to applying the discount is that it will be a discrete line on the invoice. So one line, a new line on the invoice that shows the discount rate, the consumption that it's been applied to, and therefore the benefit that you will get as a result of that discount. And then the payable amount will be the total invoice value netted with the discount applied to it. I think, does that answer the question?
Yeah, and in terms of backdating, so the earliest volume this applies to is October, is that correct?
Yeah, so because the scheme is effective from the 1st of October, the earliest that anyone will get any discounts is for consumption during that period. So, September invoices will be invoiced at their normal values and are payable at the normal rates, the contracted rates that you've agreed. It might be worth adding, so what I've described is our approach, and we are planning on further communications with impacted customers and TPIs later to go into a little bit more detail on what that will look like on the invoice, where it will appear. If you have electronic invoicing, for example, how will it appear in those files? So we're planning to follow up with a bit more detail on that. And the legislation, as we understand it, doesn't dictate to suppliers exactly how it will appear on the bill. So there may be some variation in supplier approaches as to how that will work.
Yeah, thanks, Matt. I was going to pick that point up. So you're right, it's not prescriptive and it allows for other mechanisms to be used. So that's a choice that individual suppliers will make. And I guess, that's driven by providing transparency to these recipients of the bills, what's been discounted and how it's been worked out. But also picking up my point from my introduction, it also helps and supports the auditing function as well in terms of evidencing to BEIS what suppliers have actually communicated. So it has a dual purpose in terms of the transparency.
Thanks both. So the next, I think we've covered 2 questions in one go with that one, so that's great. And then, so to move on to, will the maximum discount rates, will government supported prices be adjusted during the 6-month period, depending on market developments, such as volatility in prices within the UK or wider global markets? Matt? Gallagher again, if that's okay.
Yeah, sure. So what the government have announced and BEIS have told us so far is that the supported prices are not expected to change through this winter. The maximum discounts have also been set and will be subject to review. So I think what they've said is the maximum discount won't increase. So regardless of if the wholesale commodity prices do continue to rise, that is still the maximum discount that any customer can receive through the scheme. If you're on a variable, out of contract or flexible contract, should say the maximum discount only applies to those products. So fixed contracts, the maximum discount doesn't apply. However, they have said if in the government's view that market and commodity prices fall sustainably, they may review the maximum discount and reduce that. So that's the only thing that they've announced explicitly that they will review and may change, and suppliers should be given 30 days notice if that is the case. And I guess the other thing to mention is what Rob covered in one of his early slides is that, you know, the government have retained powers to make changes to the scheme. So we can't guarantee there won't be other changes, but that's the information we have so far.
Just to add, Helen, that where the government tracks wholesale prices and in its opinion, the evidence says that those prices have reduced, they can, as Matt's described, reduce the price. The instrument as it's drafted does say that they're not necessarily going to review it, and in the event it goes back up, track it back upwards. So potentially that reduction could be a one-way journey insofar as not tracking wholesale prices in the event that they subsequently then go back up again.
Okay, thanks both. We've got about 3 more minutes left, but I'm going to try and get through as many of these remaining questions as we've got. So what is the likelihood of extending the supported wholesale price to the rest of the year or into summer 2023? Rob?
Yeah, crystal ball time, I'm afraid. So as I've described, the scheme as it's currently set out runs to the end of March. That aligns now to the energy price guarantee that's in place for domestic consumers. And following the Jeremy Hunt's announcement on Monday, I think all of that's going to be captured as part of a wide government review in terms of what's the next steps and what and how does government want to intervene and support consumers in the market through the spring, summer, and into autumn of next year. So unfortunately, Helen, I can't give a better answer than that. We only know with a certain degree of certainty what's in front of us for the next 6 months. Beyond that, at the moment, I would just be purely speculating. And I know that's probably going to frustrate a number of people, but it's the simple facts at this stage as we understand them.
Okay, that may well be the answer for the next question as well then, but I'll ask it anyway. So has there been any guidance on those industry sectors or businesses that would be classed as energy vulnerable beyond March 23? So I'll ask Matt Cullen, but Rob, you might have a view as well.
It's the $1 million question. We have no indication, unfortunately, about what the government means by vulnerable business, or other than that they've kind of thrown out some high-level examples, such as like the hospitality sector could be deemed as vulnerable to high prices, but we certainly don't have a list from the government of industry sectors that will be considered post April next year, I'm afraid.
And would that be subject to consultation? Would there be a chance for businesses to have their say on that?
Well, given the speed that everything has been happening at, any consultations are tending to be very, very limited and very, very short at the moment. If the government gets on top of this, then I would hope that they would go out to industry and ask our opinion. But if they're still sort of running around trying to fight fires, then there's every chance that we won't get asked, pretty much like what's happened now, to be honest. So.
Okay, thank you. Right, so last of our pre-submitted questions, we might get a chance to ask one or two of the live questions as well. Is the support guaranteed for 6 months, or could it end after 3 months? Rob, maybe you could answer that one.
I thought you might ask me. So the scheme, in terms of its intent, is certainly for it to last for 6 months, taking it through to the end of March next year. The scheme has the provision, as it's currently written, to have a review after 3 months. I don't believe the government will change the commitment they've made. I just don't think politically that would be expedient. But we're in very uncharted times at the moment, so I want to reassure people as much as I can without being able to give you a firm commitment. Certainly, what happens beyond the next 6 months, again, that's pretty much crystal ball time. But unfortunately, I can't with any certainty give any sort of clarity on what's likely to happen, other than I hope that it's going to last for the 6 months that we're planning for.
Okay, thank you. So one of the questions we've had through is around, does the EBRS apply to financial contracts as well as physical? Matt, maybe you have a view or know the answer. So
yeah, the guidance we've been given by BEIS is that if customers have a financial instrument in place that is perhaps mitigating their exposure to some of these commodity costs, it is the customer's responsibility to disclose those arrangements. So I think, in essence, the government doesn't want to pay out to customers who have already mitigated the high costs. The statutory instrument will describe in detail, who's responsible for what, but our understanding at the moment is it is up to the customer to disclose their arrangements, and then between the supplier and BEIS, an adjustment would likely to be made to what support they get through the scheme.
Okay, thank you. Sure. I'm going to ask one more question before we close, and as I said before, we'll get back to everybody individually for any of the questions that we haven't got to. There are a number of specific contract scenarios as well that we can get back to directly. So the question that I'll end with is, will the rates be applied or the discounts be applied to both day and night rates?
So I'll pick that up, Helen. So yeah, as in the example, the discount will be applied to the consumption, the total consumption for the period that's been invoiced. Now, the approach we're taking in NBS is that because that discount will appear as a separate line on your invoice, it won't change your day and night rates. So it will be a one-line credit at the bottom, but it will be applied to both the day and night consumption for that invoice period.
Okay, fab. So we'll end it there. I guess, are there any kind of final parting messages we want to share, any of our speakers, on kind of like the key messages we'd want to get across to businesses?
Not from me, thank you.
Nothing to add at the moment, thanks.
I think I'd say that this is quite a fast-moving area. We think we've got all of the detail we need to operate, and we will be implementing this from the October invoices. But this is a very live space, and we recommend that customers keep engaged, keep talking to your contact within Empower if you have questions, and if there are further developments, then we'll certainly explore further webinars to talk about it.
Well said, thank you. Right, well, thank you for joining us. We, as I said at the beginning, we'll be answering all your questions, and we'll also make sure we get a link out at the end of the webinar where you'll be able to watch it again and see the slides as well. So thank you for joining.
Thank you.